These are the 5 red flags that you should be aware of when looking at your annual super statement. The first one is making sure you actually get a super statement. You may have the address wrong. It's really common to see that. To find all your super funds, you can go on the ATO portal on MyGov and see all of the super funds that you should have, and then update your address from there if you're not receiving these statements. Next, what you want to do is look at the contributions field and make sure your employer is putting in the right amount of contributions. So for the last financial year, it was 11% of your income. So if you times that by 11%, should be roughly that. It might be a little bit less because of some timing issues around when contributions were made, but it's good to double check that. The next area you want to look at is the investment options section and look at the rate of return and compare that to a relevant benchmark to see if that's performing well. You can use the ATO super comparison tool, which is pretty rudimentary. It mainly compares the MySuper options, or if you want it done more precise and in more detail, then as a financial planner, we've got all the software to compare all the different investment options out there and see if your investments are performing well for the amount of growth versus defensive exposure that you do have. On the growth versus defensive split, that's something else that you need to be aware of. Typically, with super funds, they'll give you a higher growth percentage the longer you have to retirement, but sometimes they don't actually change it down as you get close to retirement. So if you're getting close to retirement particularly, you should look at that. And if you need help with that, reach out, of course, because more growth investments does mean typically better returns long term, but does mean more volatility, which is not what a lot of retirees want. The next part, really important here, your life insurances and income protection, because with a lot of people, this did get cancelled on them a few years ago as an unintended consequence of some super reforms. So make sure you've got insurance, first step, but then have you got enough insurance? As a really general rule of thumb, you should have at least the amount of your mortgage in death and TPD cover. Now that's very rule of thumb, because what we actually do is calculate how much you actually need to cover your current lifestyle based on things like your mortgage, how many kids you have, income, all those sorts of things. And most people find you don't have that much, and therefore you need to review your insurance. Then you need to look at your salary continuance or income protection amount and make sure that that is 70 or 75% of your income. And ideally, the benefit period is running to age 65, not just a 2-year benefit. Now, in super, you can't have trauma insurance, which is one gap that we also help plug for clients. But typically, I would say it's worthwhile having a whole review of your insurances, because sometimes the cover in super is quite expensive and also low quality relative to underwritten cover, where yes, you may have to answer a few medical questions, but once you do, the quality and cost is often better. No beneficiary, so you need to submit a beneficiary nomination form, particularly if you're in a second marriage or a blended family. I mean, everyone should do it, but particularly for that cohort. And that's the main 5 red flags with your super statement. If you need any help with that, please reach out.